Hey everyone, welcome to the channel The Lens, and this is going to be the very first video of this channel. So far I've only been making some shorts, some informative shorts that you might have seen, might not have seen. But from now on I would be dedicating my time to make some informative videos that could be helpful for you in terms of your investments, in terms of your financial education. And the topic today that I've come up with is risk and returns. So basically, when you're trying to invest in any fund or in any stock, the two risk components that you see are your unsystematic risk and your systematic risk. So unsystematic risk is basically your alpha risk, right? Which is purely attributed to the operations and management of the company. Okay. Your beta risk is something which has got nothing to do with the company. You as a company can't do anything much about it. It is purely because of the external factors that you have, surrounding you, in terms of, say, currency problem that we are right now facing. Your rupee value is going down with respect to the dollar value. Then you have inflation. You had COVID. That was again a external factor. Now the risks associated with these factors are called as beta risk, which is the systematic risk, right? Risk that you can attribute to the market itself. Alpha risk are the risks which are arising purely because of the operations and management of the company. Now if I have to share my screen with you in order to make you understand more about this. Okay, so here, as you can see, is your y-axis, right? And here you have your x-axis. Now your Y company's overall returns are on your y-axis, and you have Nifty returns, which is nothing but the market returns, on your x-axis. Now if you draw a line which is based on your alpha plus beta x values, this gives your company's overall returns in which you're trying to invest in, or in which you're going to invest in, right? To make it more clear for you, what I'll do is, let me take this color. Okay. Now, as I told you that your alpha is nothing but your unsystematic risk, right, which is arising purely based on your operations and management within the company. It has got nothing at all to do with the market, right? Now your beta is something which is called as a systematic risk. It has got nothing to do with the company itself. The external factors like COVID that you had, the currency problem that we are facing right now, the inflation is something which you as a company can't do much about it, right? This is called your systematic risk, and the returns associated with this unsystematic and systematic risk are called as your unsystematic returns and your systematic returns, right? So your Y, which is your overall Y company's overall returns, the company wherein you're trying to invest in, right, is equal to your unsystematic returns plus your systematic returns. Now what is beta? Say for example, beta is nothing but your tells you how sensitive you are with respect to the market. Say if your beta value is 0.8, which predicts that, which says that if your market goes up by 10%, you would go up by 8%, or if your market goes down by 10%, you would go down by 8% only, right? Because your beta value is lower than 1. You are not that sensitive with respect to the market. But if your value on the other hand is 1.1 or 1.2, in that case, if your market goes up by 10%, you would go up by 12%, and if your market goes down by 10%, you would go down by 12%. That means you are overly sensitive with respect to the market, right? So this is something which your beta explains. Alpha is, as I told you, completely based on your operations and management which are happening with the company, nothing to do with the market at all. So your 0.8, the value that I just showed you, your beta value, multiplied by your X, which is your market returns. There is nothing but the Nifty returns. If your market goes up by 10%, so 10% into 0.8 gives you a systematic return, which is 8%, which I just showed you over here, right? Similarly 12%, 1.2 multiplied by 10% would give you 12%, right? So this is your beta is nothing but systematic returns, alpha is nothing but unsystematic returns. Clear until this point? Okay, so now let's give you a practical application of this risk and returns topic that we have just discussed. And let me just go to equity large cap funds. So mutual funds, equity large cap, and let me just go to risk tab and let me just export it to Excel. And then let me go to returns tab, click on long term tab and click on export to Excel. When I do that, what I get is this list having the 161 funds, and what I've done is I've just taken a sample of it from Bharat 2022 ETF up till your DSP Nifty 50 equal weight index fund, which is this. So I've taken this sample, and what I've done is I have, as I showed you earlier, I click on this return tab and I've exported this as well to Excel. Now if I go here to show you, yeah, so this is your funds with your 3-year returns, 5-year returns, 10-year returns, right? So what I've done over here post this is I have sorted these values. First what I've done is, let me show this to you, sort data sort. So the first level of sorting has been done on alpha, largest to smallest values. Then the second level of sorting I've done on beta, again largest to smallest values, and the third sorting I've done on R squared layer, again largest to smallest value. Now what is R squared, you must be wondering. So R squared is nothing but a statistical measure which gives you as to how much variation in company Y in which you are trying to invest can be explained by the changes in or the variation in market. So say if your R squared value is 80%, that means you are 80% correlated to the market. If your R squared is 0.8, that says 80% of the variations which are happening in company Y can be purely explained by the market, the changes which are happening in market, right? Now, clear up till this point. Now what I've done is I've taken the returns from this, right, your 3-year returns. I've just applied the VLOOKUP for this fund in order to get the 3-year returns values. This is nothing but the 3-year return value. If I have to show this, while 22 ETF 26.28, by 22 ETF okay, let me just show this to you in this way. Control C, 22 ETF, Control V, so 26.28, right? Here it is 26.28. So these are nothing but your 3-year return values. Then I've calculated returns per unit risk in order to just to show you that if we are taking 1 unit of risk by investing in this fund versus 1 unit of risk that we are taking in by investing in this fund, what are the returns that we are getting per unit risk that we are taking. So here obviously you're seeing that the returns that you're getting per unit of risk that you are taking is more for VAR 22 ETF, which is a good thing, right? You should be getting more returns per unit of risk that you are taking, right? Now basis this, you can see VAR 22 ETF is the one which has the highest alpha value, good for us. Beta value again 1.02. if the market goes up by say 10%, it would go up by 10.2%, right? And R square value is again 0.7, which is again a good thing. It means that your variations in VAR 22 ETF can be explained, 71% of those variations can be explained with the market itself, right? Now if I have to show on by going to the Grow app as to what does the Grow app analysis says about VAR 22 ETF, the key in VAR 22 ETF over here. If you see the fund returns for a 5-year basis are 25.8%. The category average for this particular type of fund is 15.9%. Again 3-year average 11.6%, but this fund is offering you 26.3% on a 3-year basis, right? And the category ranking also you can see over here is 1 and 1, which further validates it, right? And you can similarly do such type of analysis from now on at your end as well. Let me know if in case you have certain questions. I would be more than happy to help. I'll see you in my next video. Till then, take care. Bye bye.